Hi, and welcome to April's workshop webinar for Ask Me Anything about money and money mindset. So this one's an interesting one. Normally I am going to do some pre-prepared content, but normally I just do a topic and then people can ask me about that topic. But I figured when we're on our journey, no matter where we are actually in the journey, because the more we start to know, the more we realize we don't know, and then we have more questions, and they just start to compound. So I thought I would do an Ask Me Anything episode of this webinar series, because we often have, who do we ask when it comes to money? I know I didn't know. I was like, if I ask somebody from a bank, they're going to give me their perspective. I ask a financial planner. It depends on the financial planner. The one that I used to have was just very much product based and would just sort of refer me to the product providers that he worked with. And I was like, okay, well, that's also shaded. So I thought I'll just do Ask Me Anything. So I'll just go into a little bit, if you don't know me, a little bit of my background. So my name is actually Alpha. And I work with primarily women and primarily business owners to help them understand and manage their money mindset, and then help them connect their business finances to their personal finances. Because you can't really fix one without the other unless you understand how the two flow together and how they connect. It becomes really difficult to manage both effectively, especially when we have accountants and bookkeepers to help us on the business side. And even if they prepare our personal tax returns, and they're not going to help us actually manage our cash flow and our money. So that's where and coming from a tax background, that's my original hat was a tax accountant, and I saw so many gaps and things in people's knowledge and understanding, and to a certain extent their desire to as well. And I thought, no, there's got to be more, which is why I stopped going down the path of tax accounting and I started down the path of financial planning, but realized there's also a lot of gaps in what they're capable of doing as well. So that's how I've ended up doing what I am now. So, what actually triggered me on the journey was my own journey. We all start with our own things that we need to figure out. And as I said, like I started in tax accounting and I'd studied accounting at university. And when went into building up my life, I realized I don't actually know much about personal finances. So that sent me down an education path there, which took me down a financial planning path. And then I realized all the things again that we're not taught about, not just personal finances but business finances, when I started my own. And I thought, oh my goodness, there's so much to it. It doesn't have to be complex, and we often don't know where to start, so we focus on the wrong areas. So that's me as a on the left, as very young, naive. I look at that and go, oh my goodness, I had so many things that I didn't know that I didn't know. So, blissful ignorance. And then on the right hand side, that's me about 2 years ago with my daughter, who's now 8. And one of our big dreams was to go visit Uluru. My daughter still remembers the Big Red Rock and absolutely loves that. And I loved that I had the ability to go and take her to something like that. We even did a helicopter tour, and it was a really special trip. Right. So the pre-prepared topics, I was going to talk about money and mindset because it's important to understand how they all work together. Just making sure no one else is coming in. No, not yet. And then I'm going to go through some common money questions that I get asked, and then we'll go into Q&A. So some of the money and mindset, if you've watched anything I've done before, some of this will be familiar. The common money questions, though, there might be some new stuff in there. So I'll just dive right in. So, money history, I thought it's important to actually look at how we actually got to where we are. Because quite often, in order to understand where things are now, we need to understand where we've come from. And when I went and did a bit of research, and I sort of was looking at the journey, and I was aware of the barter system. So that's where we really started. It was a transaction, but we didn't use physical money or even digital money like we do now to exchange. We exchanged goods. So we exchanged services for goods, goods for goods, services for services. And that's how it started out. We decided what, as an individual transaction, what we thought was valuable enough to exchange our services with. And I grew up in a very European community here in Brisbane, and there was a lot of bartering that went on. Someone made baklava and they exchanged it for rakia, or they, whatever somebody made, and they exchanged, and it was beautiful. And it wasn't there to try and circumvent the tax or whatever systems. It was just because somebody made something of value and someone else did, and they decided to exchange it. So that's how we started out with bartering. Then money came. This next bit I was actually quite interested in when I was doing some research. So obviously, because it's so far back, there's a lot of different ideas and perspectives on where this sort of came from. But money the earliest known mints to make money were back in 650. And I've got BC there because I realize there's, there's different ways of communicating that now, but it was a very long time ago in what was then Asia Minor, which modern day we call Turkey. And it started as not like coins or things. It started as shells. If you think about it, money itself, we can assign value to because we want to. So we could really assign value to anything. I could assign value to my mouse if I really wanted to, but it has to be recognized by others as well. And so it then progressed into other natural items and then onto gold or silver coins, and then progressed onto paper and metal coins. And then now it's pretty much digital. Then the concept of a bank, because when people started to sort of gather money, they're like, okay, well, what do we do with these physical shells or coins or paper or whatever it is? And this started way back in the Roman Empire. And there's lots of history around banking, which I'm not going to go into. And then the concept of managing money, people used envelopes as well. We all know the envelope system. And then now we've progressed to what I call digital overwhelm, because there's so many different types of legitimate and not so legitimate currency. I mean, I'm not even going to go down the rabbit hole of crypto unless someone asks me about it. But yeah, so that's the history of how we've actually come from bartering to our modern day of digital. So then what is money mindset? So we hear a lot about mindset these days, and specifically money mindset as well. And I was actually on a mastermind call this morning where it was specifically in relation to mindset, not just money. And this is so much about it. When it comes to money though, it's very much about what we believe our relationship is with money, what we believe about money, what we believe about our ability to manage money, to attract it, and how we spend it. That then translates, so what we believe in our own mind then translates into our behavior and those experiences that we have. So, and then those repeated behaviors and repeated experiences then become our habits. So we get into a certain habit, like paying a bill on time, or not paying off a credit card, or looking to pay for something with debt rather than savings. Those sorts of things become habits. And so this is what the formation, I'll move on to the next slide, is of our money mindset. And so we start out with that sense of self, our identity. And if you've ever read James Clear's Atomic Habits, this will be very familiar. So our sense of self, where he calls it identity. And then we have our beliefs that form out of that, because what we believe is our reality. So perception is reality. Then our behaviors that we do, because we believe a certain way. So we then behave a certain way, and then we do that often enough, and then we embed a habit. And then there's a whole other topic about how to fix that and how to interrupt that formation or that reinforcement loop. But that's essentially our mindset, and specifically relation to money. So money habits, I've just got a couple of examples here. So for a business owner, specifically your habits in terms of paying yourself first. It's a difficult one. Again, that Mike Mikhailovich, I don't know how to pronounce his name properly, but from Profit First is very much about pay yourself, but pay profit, pay yourself. And I'm also reinforcing pay super. Very important, especially for women. Understanding your numbers. And a lot of the times you don't need to know all of them. I feel like when it comes to anything really where we feel overwhelmed, especially around money, we feel like we need to know and fix everything all at once. We don't. We just need to know one thing, and then we can move on to the next thing. And then as far as our numbers go, you might only need to know 2 or 3 to start with. And then once they become familiar, you can expand from there. So we don't have to do everything all at once. And sometimes some things are actually a little bit of trial and error. And we're like, okay, well, which metric do I actually find the most useful? But you don't know until you start to develop, move into it. Setting financial goals is another important one. So actually, what revenue or income do you want? And then how, building it up backwards, how are you actually going to achieve that? What products and services will you sell in order to get there? And how much of each of those do you need to sell? Tracking, very important to track so you can see how you're going. How is your forecasting going to what is actually happening? How are the trends going? So you can start to look backwards and see some patterns of people's behavior, your clients' behavior. Without that knowledge, it becomes very difficult to make the right forward decisions as well. So in business, we talk a lot about lead and lag indicators. So these things are going backwards and forwards, giving you indications of how things are going and what you need to do and change. When it comes to mindset habits, then as a business owner, you're looking at languaging. Languaging is extremely important. And again, another book that I would highly recommend that actually has some of this in there is Don Miguel Ruiz's The Four Agreements. That book is fantastic. It talks about language. It's not to do with money, habits, or anything. This is just purely personal development. I love personal development. But he talks about language. We often, just as an example, whenever I want to try and remember something, I listen to the language because I'm tuned into it. That a lot of people say like, "Oh, don't forget to." And I was like, no, 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 no. What are you focusing on? You're focusing on forgetting the thing. What you want to do is remember it. So I would need to remember to, and then you're more likely to remember it because you're focusing on remembering. That's just a very simplistic example, but how you want things to go rather than how you don't want things to go. A, it's nicer to focus on the positive, and B, it's more likely to happen. And even if it doesn't, we'll still figure out how to manage it. But at least it feels nicer in the journey to get there, rather than constantly going, oh, what if this doesn't work? Or what if this doesn't work? Or what if, I forget this? What I like, okay, well, enough with the downing. I mean, and our brains are wired for survival, which generally tends towards the negative anyway. Another rabbit hole, which I won't go down right now. Don't make assumptions. You never know what's going on with people. I have made this mistake in my business before where, clients have said they want to do work with me and then they disappear. And then at first you'd be like churning and churning. And I thought, okay, how would I respond to this as a human being? I would check in and just say, are you okay? Not because I necessarily want to prod them in the business direction, but because they seemed interested and something's happened. I want to check to see if they're okay. And every time I've done that, there's usually been like I had one client where her best friend had committed suicide. So pretty traumatic. And I didn't want to be this person who's like, okay, so I'm going to follow up on the sale. No, it was just as a human connecting with another human. So never make assumptions about why people do or don't do things. Focus on your habits. It is actually important. It sounds boring, but once you get them embedded, there's so many things now. I was asked about procrastination not that long ago, and I was like, I actually had to think about it because I thought, it's actually not that much that I really procrastinate about because I've worked so hard on my habits and getting my life into a rhythm where I don't not enjoy a lot of things. I turn it around to the point where I can enjoy the things that I previously didn't. Even eating and the way I eat and the exercise and all of that. You get up in bed out of bed sometimes. I'm like, oh, do I really want to go for it's raining outside. I'm meant to go for a bike ride today. And I'm like, you know what? It's going to be refreshing. I'm going to get sweaty anyway. So let's go out in nature. And they're usually my best rides. And I come back absolutely dripping wet, like every single part of my body's wet. I don't even know how it gets wet in some of the areas. And they're great. And then I feel even more proud of myself because I've done it. So then that sets you up for doing other things that you previously thought you would avoid. So it's really important to have those agreements with yourself. And then tracking your progress. Once again, looking back and say, did I do the things that I committed to myself that I'm going to do? This is not because you have an accountability coach or anybody else there, although that is helpful, but did you keep the agreement you made with yourself? That is the most important thing in the world. So financially, mentally, physically, with people, anything. So as you can tell, I get very passionate about this. So I will continue on before I take up too much time. Now, common money questions that I get. Some of these might be in your head already. If not, feel free to ask me others after I've gone through these. But I get a lot about how can I budget better, which is basically how do I spend less? That's generally what's behind that one. People don't tend to think in terms of making more money. They tend to think in terms of spending less, which is a little bit scarcity. So there's a mindset built into that too. But anyway, we'll get to that in a moment. Another one, how can I pay off my mortgage faster? And can I invest? So there's a bit sort of two questions buried in this. And then how can I invest while, or should I invest while paying off my mortgage? My answer to that is yes. When it comes to money, we don't do things sequentially. Lots of things have to be done in parallel, but there are a lot of caveats to that in your situation and your needs and all of that too. But there are ways to do it. And I'll go through some of those. How do I save for my kids? I get that one a lot too, because we think of saving for children and we think, oh my goodness, tax. And having come from that background, that's usually where my brain goes first. I was like, okay, well, how will this impact my tax situation? How can I structure things better? So there are ways to save for children. Again, this really depends on the tax bracket that you are actually in. So I will talk about some options. And another one that I get quite a lot from business owners who've been in business for a while is, are self-managed super funds any good? Like, how do they work? Should I do one? I've heard somebody say they're fantastic. I should do one straight away. And I was like, well, what's and really interesting. The last time I got asked this question, I subscribed to Money Magazine. And there was an article about self-managed super funds, and I have my own personal opinion about it. And I thought, I'll just look, this is really good, timely. I'll have a read. And I'm reading, and one of the first things he said is, "Don't do it." I was like, "Oh, okay." He then went into a lot more detail over about 4 pages as to why and what options and what the makeup of them are. But they're not as simple as we often think they are, and they're not as valuable as we often think they are as well. Again, depending on your situation. So I'll launch into the answers for those. So budgeting. Now, budgeting is boring. There's no real way to sugarcoat that one. The idea of going through your, like, I'm literally actually just before this, I've spent about an hour or so for a client going through their finances, and it is boring. Even with the way I know how to do formulas in Excel and how I'm going to, how I can shortcut things, but it is boring. So rather than doing that, and sometimes you do have to do an initial view over maybe 3 to 6 months so that you can capture all your normal expenses. Then you categorize them, and then you chuck them into buckets, and you manage the buckets, or the pie slices as I've got here. So you don't actually have to micromanage your finances line by line. I had a client once who said they like to manage it weekly. I was like, really? You're going to go through all of your expenses and all of your income on a weekly basis? Wow, go you. So I set up the spreadsheet and the systems for her to be able to do that. After about a month, she's like, "Can we switch to monthly?" And I'm like, "Yeah." I don't know who likes to do this stuff weekly, even monthly. I tend to do it more quarterly, to be honest. But I manage it at a bucket level. And so you have your money, and for your business, you have your operating account, and that's where your expenses will come out of. At least have enough there to pay your expenses for 3 months. Then put money aside to pay your taxes, because you don't want to be caught short. I shouldn't say rescue, but I've worked with so many clients who haven't done that, and their accountants haven't even helped them do that, because technically it's not really their job. It's not their job to make sure you're putting your money aside for tax, but some will help with that. Profit. Absolutely have some money in an account for profit. Doesn't matter how much you're making, even if it's just 1% of your revenue, just put some money aside there. It's mentally so much better when you can see money going in and growing in your business, even if other areas aren't growing. Paying yourself a salary. And that is what's going to lead into my next slide. And then a holding account there, that is to help cover the down months when income goes down or expenses go up, where you have, something dips and you haven't got enough in your operating account and you don't want to dip into your taxes or your salary or your profit. That holding account will help you with that. It helps smooth things out. So that's how to help budget, but you do have to know what's going in there, and you do have to streamline. The client that I was looking at before, you can see the pattern of behavior, and you can see when people get stressed because their takeout increases. So I've started to see where the takeout costs have gone up and they've added Netflix. And I was like, right, okay, something's going on there. So you start to actually see your patterns of behavior when you look at your spending, and then you can start to make assessments. Like, I've been very, very strict in our household. We have 2 streaming services, and one of them is Prime, primarily because I buy lots of stuff. Well, not lots, but I buy stuff on there. So it has a twofold effect. But I'm not buying any more. There was something on, I think, Apple TV, and we had a free trial. I was like, all right, I'm going to use the free trial. And then once we're finished with what we're watching, that's it. I'm canceling. I only want 2 streaming services, and I've had clients where they have like 5 or 6. I didn't even know there were that many, but anyway, there are. So then you take that salary slice, and that fits into this pie. Similar concept. Once you get them all up and running, the pie will just help you manage it so much better. So you have your spend, which is your operating account equivalent to your business. You look at your bills, look at your debt, you figure out what your actual payment requirements are. Then you can manage your debt payments, which we'll talk about shortly. Look at investing. Investing is important. Put some money aside for that. You can put some money aside for saving for kids. And this is where it all starts to fit together. When you see it in this holistic way, then you make sure you're like, okay, well, how do I make that happen? Like, how do I make the investing happen? How do I make the saving happen? And it's a lot easier to ask 2 questions like that than to go, oh, I don't even know what to ask. Let's just start with those 2 and then move on to others. Or let's just start with one. I did a podcast this week talking about how to make money fun. I was like, let's just focus on the fun fund. That's it. We're not focusing on anything else, just fun. Because let's say fun's fun. And then emergencies or rainy days, I call it buffer because it sounds a little less, serious, but whatever you want to call it. So then you get to manage your buckets or your pie slices. Then now with paying off debt, so how do you actually pay off debt or pay off your mortgage faster? there are a number of different ways that you can do this, but ultimately it's about trying to consolidate and eliminate. So we're looking at, say, if this is your baseline, we're looking at going down, not adding, going down, which can sometimes be a little bit difficult. But when you start to look at your spending, that's when you can cut things out and work less relying on debt and looking more at relying on savings if you need to. So looking at how, like, you've got these credit card transfer. Oops, sorry, I just saw there's something in the chat. Budgeting. You love budgeting. Oh, that's fantastic, Caroline. You are unique. Not many people love budgeting. But it is really exciting. And this is the thing. The more you do it and the more you get into it, the more exciting it does actually get, because it gives you the option to do other things with your money. You don't have to worry about constantly penny pinching because you know you've got it. You're like, okay, yeah, I can. Like, even on Friday, my daughter and I were out doing stuff and we didn't have time to come home and have lunch. I was like, you know what? Let's just go get Sushi Train because we can. And I don't have to feel guilty about that because I've budgeted extra stuff in my budget for that. So it then just makes life easier and you don't have to constantly worry about it. So yes, absolutely. So consolidating debt, using balance transfer for credit cards if you have to. Stay away from buy now, pay later, please. It's just, yeah. I see these afterpay sales and I just cringe. I really hope people aren't clicking on this. And I had a client recently who had about 4 different buy now, pay laters because she kept using a different email address and they just kept giving her more and more money. And I thought, oh gosh. Anyway, so if you have a mortgage and you can consolidate, do that, and then get rid of all of those like credit cards. Obviously, probably need to hang on to one. If you can make it a debit card, do that. But really try and build the budget into the debt elimination, and then look at ways to actually pay down your mortgage, which is pay fortnightly, pay extra, things like that, to actually really, really start to get that debt down. And then whenever you've paid off a debt, you pay what you were paying on that debt onto the next one. And once you've got the immediate ones done, then you can start to save for investing. So yeah, so this is the snowball effect. I actually quite like. I heard the other day there was a snowball, there was a tsunami, and there was some. Anyway, there were a few different ways. I was like, let's just stick with one. It's simpler. So I do it by highest interest rate because I don't like paying the banks any more money than I absolutely have to. So order your debts in terms of highest interest rate to lowest and just smash it, get it out there. Even though the interest rates have gone up, your home loan is still probably going to be your lowest interest debt. So by the time you get there, and that will be your biggest one as well. So get rid of all those other smaller ones, try and just live within your means after that, and then just focus on getting that mortgage paid off while also putting money aside to invest. There we go. On the investing, I get a lot of questions about like how do you invest? Like, what are the different ways? So there's actually quite a few. And modern day platforms have made investing so much easier and getting access to it. So superannuation is an investment in itself. So having superannuation, you've got investments in there, and also within superannuation funds now, they've even made, and we'll talk about this with the self-managed super fund conversation as well, it's made doing different types of investing within your super so much more empowered for you as the customer, as the owner of your super fund. So superannuation, you can micro invest. At the very least, I suggest everyone start with that. If you haven't done anything else, start with the micro investing. Property, you can, there's commercial and residential. Commercial is a lot more lucrative, but it's also a lot more expensive to get into. I grew up with the concept of you buy property, you buy property, you buy property, and that's the way to build wealth. It may have been back in the 80s and maybe a bit of the 90s, but we get letters from real estate agents every week with, will you sell your house? We have a buyer. And I look at the property prices and I just like, oh my gosh, they're at least double what we paid for our house. I don't know how people afford it. I really don't. But there are ways you can still invest in property without having to buy outright a property. You can buy units in a property trust. So you don't actually have to buy, like, for instance, the company, the one BWT Trust, I think Scott Pape, the Barefoot Investor, recommends this one or suggests this one. And they own all the lands that your Bunnings, the hardware stores and all of that are on. So, they're not exactly going anywhere. You can buy shares in companies. So there's blue chip companies, which are like your really big ones, your banks, your big companies like your BHP, your Rio Tintos, all of that, ones that are considered more stable. And then you can also buy bits of assets inside your exchange traded funds and your managed funds. You can trade foreign exchange if you want. That one is a little bit more risky, and you definitely have to know what you're doing with that. Then you've got digital assets, cryptocurrencies, NFTs, which are non-fungible tokens, which that is another whole area which I know makes sense to some people. It's never been something that's interested me personally, but they're available, and they're not actually officially considered an investment class as far as the Australian definition of that goes, but they are still around. And then you've got other things like gold. You can buy gold, you can buy silver, you can buy commodity, buy into commodities. Gold and silver you can actually physically hold. And I did do that a number of years ago. And then I read Barefoot Investor's book, and he's like, oh, you never actually earn income on it. It's capital. I read it, I went, yeah, actually that makes sense. I got caught up in something. But it was an interesting exercise. And thankfully I did actually make a capital gain on it, but that was more luck than anything else. And you can buy art and antiquities and gems and jewelry, not as easily transferred into cash, but there are also ways of investing. Saving for kids, that's another big one. But there are a number of different ways. I've just put the main three there. There are a lot of things to consider there in terms of what tax bracket you're in, what you want to save for, how long you want to save, what structure you want to put it in. Do you want to put it into a trust? Do you want it directly in your name? High interest bank account is probably the most straightforward, simple one. You can just open a bank account, put money into it, and it's still going to be in your name, but you can earmark it for your child or your children. You can invest in their name as well. So you can set up like an exchange traded fund account and just put money in there regularly as well. That's another option too. A growth bond is another option. I actually personally do this for my daughter. I opened one up as soon as she was born, and it's an investment vehicle. So there is still, investment risk involved with it. And there are some rules around it as well, but it's more tax effective, which is why I use it. So it caps your tax at 30%. There are rules around that. Anyway, I would suggest if you want to look into it, basically that came out. They're also called insurance bonds originally because people used to use them to self-insure before the huge industry of life insurance and that came about. People used to insure themselves through things like growth bonds, but they do have what they call a child advancement policy in them. So it's essentially you're setting up a trust. And you can say at what age you want it to vest to your child. I have vested to my daughter when she turns 21. So I'm hoping by the age of 21, she has enough financial sense that she'll, use it wisely. So they're just a few ways that you can invest for your children. Oh, the one thing I do want to mention, some of the growth bonds that exist are purely for education. So you can only use them for education. You've got to be really sure that you want to use it for education. I personally prefer ones that don't restrict you on what you spend it on, because I don't know what my daughter's going to want to do in 10 years' time. Is she going to want to go to university? I don't know. Is she going to want to do a TAFE course and a trade? I don't know. Maybe she wants to go travel the world for a year. So I don't want to restrict what it gets spent on. So that's the only thing I would suggest thinking about. In terms of saving, and this doesn't just go for saving for kids, this is just in general as well. So if you look at the concept of over a 10-year period, if you started with $100 and you invested $100 every month for 10 years, and you didn't increase that, it was just straight $100, and you're looking at like a savings account, and I've put in a 4% return because I know they're a bit higher at the moment, but they won't always stay that way. So averaging, you'll end up with nearly $15,000. And if you did nothing, you wouldn't have that. Like that's the value of compounding. It's really, really important. And then with investing, I'm going to put 8% return. That's still sort of on the lowish side. And I've also put in fees for this one because generally speaking, there will be some fees involved. I put 0.8% because you can get ETFs that are lower than that, but you shouldn't pay much more than that. And that will give you just over $17,000. So an extra sort of $2,500 there. And that's the value. Again, if you don't do anything, you don't have that money. And 10 years down the track, you're like, I wish I started that 10 years ago. So it's a really valuable thing to do. And just like I always say, just get started. All right, self-managed super funds. These are an interesting one. So I've got here the pros. So the pros are it gives you choice and flexibility. And by that, I mean, you can put more or less whatever assets in there that you want. There are some limitations, but you can put a house in there, for example, not the house you live in. It still has to be an income producing asset. And it's flexible in terms of the structure that you use as well. So you can add assets and which commercial funds can't. So by a commercial fund, I mean like like just an industry super funds that most of us are in. They could be more tax effective, although one of the first con there, the setup fees and the fees to maintain it may outweigh the tax benefit. So it's a really, really important thing. And you'll probably find a lot of accountants love to set people up in self-managed super funds because they know they get, and I know this is quite cynical, but they do get paid quite a lot to set them up and manage them. You do get really good accountants who will actually genuinely look at someone's situation and go, is this really the best thing for them? Unless you've got about $500,000 plus worth of assets, it's not really like worth it from a cost perspective. But again, something you can definitely investigate with a good accountant. The other thing to really be aware of is that you become fully responsible for everything. Your accountant's not responsible for making sure the compliance is done. So any documentation and paperwork and everything is actually submitted. You are responsible for that. You can get them to help you do it, but they're not responsible for actually submitting it. And you're also responsible for the investment returns. So if you are comfortable enough that you know enough about it, you can definitely do it. But there's 100% of the responsibility then falls on yourself. You can then get professionals or pay professionals to help you. But again, that's going to eat into your returns and your savings a bit as well. So they're sort of the high level pros and cons of a self-managed super fund. All right, so I'll just go over. We'll go into Q&A in a moment. So money and mindset, we went through some common money questions, and I know there's quite a bit in there. So feel free to watch this again if you need to, and then we'll dive into Q&A very shortly. What I wanted to show you first, though, is if you do actually want any more help in the money space, I've got two things that I was going to show you today. One is very much around mindset and just kind of setting yourself up mentally and emotionally for money. So I set up a 30 daily practice series, which is 5 to 10 minute daily videos. There's also a playbook that helps support that. And it's designed to help give you some clarity or help you get yourself clear on what you want. It's a bit inspirational. There's motivation, there's information. It helps with focus and energy around money. So that I've kept it deliberately quite a low product, and 30 days, it will help you go and you get access to this so you can continue to do those, watch those videos again and again. So that one, if you're interested, the website is there, or you can go to my website and you can find it there as well, which is money-madesimple.com.au. The other one is a little bit more in depth. So this one is a money management assessment. So this is just a one-off session where we sit down, we go through what are your priorities? What is it that you actually want to do? Where are you stuck? Where are you not clear? What other tools and resources can I give you to help you get unstuck? And what can we do within it's 60 to 90 minute session, depending on how much time we need. And there's some additional support available if you'd like that, and some accountability if you would like that as well. But essentially, it's just a one-off, so you can get yourself reset and go, okay, well, I don't know what I don't know. I just need to figure out what my next move is. That's what this session is designed to do. So again, that one is available on my website as well. All right, so I'm going to close that presentation down and stop sharing. And then open up for any other questions that anyone on the call has. So I'm just gonna, nice to be. So because there might have been some questions that came out of what I presented as well, and you might have some extras that you already came online with. So ask away.
It was really interesting hearing about the self-managed super funds.
Mm-hmm.
How do you go about buying and building your own properties in self-managed super?
So that's when you're actually doing the contract for sale. The actual buyer will be your trust, because super funds are essentially trusts. So the buy and sale agreement, whether it's land or with a developer or whatever it actually ends up being, that contract for sale will actually be between your super fund and you would be the trustee of that, and the executor as well. So you would have signing authority, and then the as the buyer, and then whomever the seller is becomes the seller. So that then means it sits in that structure. It then gets managed. So there's a tax return that will get done, and that tax return, everything that happens with the property. So you'll keep note of what your buy price is. If it's a new build, then what all of the the maintenance, repairs, and whatever other things that will go into that. And that's where you really do need to have a professional involved. So you need to have your lawyer and accountant very closely working together in that space, because you want to make sure that you've dotted all your I's and crossed all your T's. Because super funds, especially self-managed super funds, are very regularly audited by the tax office to make sure that they're actually complying. Does that answer your
Can,
question?
yes, yes. Can you leverage bank loans through your super fund?
Can you leverage what, sorry?
Um, bank loans.
Bank loans?
Yeah,
Depends what it's for.
for that.
For that, yeah. So the interest on an investment, it then gets treated like it would any other asset. So if it's deductible, the interest is payments are deductible, then they would be deductible within that structure.
I mean, can you apply for a bank loan as a self-managed super fund?
I believe so. I believe so, because it's there's rules that keep changing in that space, which is again where an accountant would be the best person to give you current advice on that. But generally speaking, most people don't have the how many hundreds of thousands of dollars to buy a single asset, even inside a super fund. So yeah, there's properties that are in self-managed super funds that have loans on them. So there would be ways to do that. I would say that the loan to value ratio, so the LVR, would be different in a super fund, because ultimately that money is meant for retirement. So there would need to be a way to make sure it's paid off by the time you intend to retire.
Thank you.
Okay. All right. Any other questions? You already like budgeting, so we don't need to talk about budgeting.